Hello everyone and welcome to today's Mondac webinar in association with Nexdigm, who will be discussing the impact of the increased withholding tax rate on foreign companies in India. My name is Dan Sampaio and I'm joined by a brilliant panel to take us through today's discussion. Maulik Doshi has over 2 decades of experience and in-depth tax knowledge. Maulik heads tax and global transfer pricing services at Nexdigm. He ensures high-quality service delivery for the overall tax practices. He assists multinational clients on various matters, including inward investment, cross-border investment structuring, contract structuring, taxation of digital transactions, BEPS advisory, global M&A and restructurings, transactions, permanent establishments, and expatriate tax. He is a key member of the International Tax Committee of Nexia International at global level and was chair of Global Transfer Pricing Group at Nexia International. Nishit Parikh is a Master of Commerce from Mumbai University, a member of Institute of Chartered Accountants of India. Nishit has over 13 years of experience in advising several domestic and international corporates on the matters relating to international tax, FEMA, and structuring of inbound and outbound investments. Nishit also has experience in handling a wide range of cases at various levels. Nishit also leads the firm's initiative on corporate tax and transfer pricing in the UAE region. Now, before I hand over to the panel for today's webinar, a housekeeping item. You can submit questions to our panel by typing them into the questions pane of the toolbar on the right-hand side of your page, and we will endeavour to answer as many of those questions as possible, but please do reach out to the team afterwards for any additional information you may require. It's now my pleasure to hand you over to Maulik and Nishit to begin. Thank you.
Thank you, Dan. Hello, everyone. It's a pleasure to kind of present this new change that is happening in India on withholding taxes with respect to foreign companies that are likely to do business or they are already doing businesses with India. This change was kind of unanticipated. It came out of the blue. Generally, all the changes that the government does are a part of the Finance Act or the finance budget that the finance minister presents. This change was actually not a part of the finance bill that was presented by the finance minister on 1st of February. But when this bill was getting approved by the parliament, was getting passed in both houses of parliament, this change was sneaked in at that point in time. And it has a significant impact on kind of how foreign companies do their businesses with India. This change has to be read alongside some of the other changes that are happening with respect to the treaty, with respect to the OECD's base erosion, profit shifting plans and action plans, and with respect to certain procedural requirements that the government is introducing from time to time. So if I consider all of these changes put together, this is a major impact for foreign companies that are kind of doing businesses with India or they are doing businesses in India. So if you are a foreign company earning any type of service income from India, royalties from your kind of group or affiliate companies or non-affiliated companies, kind of your projects here in India, all of these kind of businesses would get affected because of these additional withholding taxes, and which is what we are kind of trying to understand over the next 40-45 minutes and then take up your questions. So with that, we kind of can move on and kind of look at what the history is. So we can move to the next slide, which kind of really provides the background. So over the last few years, the withholding tax rate in India were consistent. It was in line with the government's policy to provide consistency and certainty to foreign taxpayers and Indian taxpayers. But this was not always the case. There's a long history with respect to the withholding taxes for royalty or fees for services as per Indian Income Tax Act. At some point in time, the withholding tax rate was as high as 40%. It was a point in time when India has just kind of started allowing Indian companies to make these payments. I'm talking about mid-70s and early 80s. So at that point in time, the tax rate was very high, ensuring that kind of only genuine cases where collaboration is required because the government wanted to protect the foreign currency at that point in time. Thereafter, it was in kind of 2006 when the government reduced the withholding tax rates from 20% or 40% that was prevailing to straight 10%. And this was a major move, opened up kind of, it was a signal to kind of open up the Indian economy. It was kind of an invitation for more foreign collaboration and doing for more foreign companies to do businesses with India. The idea was to see how FDI can be increased, how foreign collaborations can work on infrastructure and other projects here in India. This rate kind of 10% pretty much prevailed throughout the tenure, except for a brief time of between 2013 to 2015 when the rate was increased to 25%. But again, after the changing government and the new government coming in 2015, the rate was reduced back to 10%. So we saw some kind of changes there. In 2010, interestingly, while the rate did not change, the government introduced a penal provision which provided that if the foreign company that is doing business with India does not have a Indian tax identification number known as PAN, permanent account number, then there will be a penal rate of 20% that will be there. But this also kind of over the years the government liberalized, saying that okay, if the foreign company does provide certain documentation in terms of TRC, even if there is no permanent account number, they are going to accept a 10% rate. Now the major amendment came in now this 2023, which kind of is effective now as we speak, became effective from 1st of April 2023, where the withholding tax rate as per the Indian Income Tax Act increased to 20% from the earlier 10% rate. It was prevailing till 31st of March 23. Now, so all payments for royalties or FTAs under the Indian income tax law would be subject to a 20% withholding. And to add to this 20%, there will be surcharge and cess additional, taking the effective rate closer to 23%. We can move to the next slide. So this is a broad comparison in terms of the nature of payment and the withholding tax rates, which was there prior to the change, which was for royalty fees for technical services, the rate was 10%. After the change, it's increased to 20%. And by and large, most tax treaty rate are still lower, which provide most of the tax treaties provide for either a 10% or a 15% withholding tax on royalty. There are certain tax treaties where the fees for technical services are very narrowly defined, so you could actually get away with a 0% withholding, or there are certain tax treaties. Most tax treaties in Europe, etc., follow a 10% withholding, and US and UK are the two specific tax treaties where there's a 15% withholding on royalty or fees for technical services. Now, as per the Indian law, the withholding tax would be applicable depending on whether the non-resident taxpayer is eligible to claim tax treaty, and if the tax treaty rate is more beneficial, that would apply. So you can actually choose which rate is beneficial, whether the Indian income tax law or the tax treaty rate, and whichever is more beneficial rate, you can kind of choose to apply that. Now, if you understand this now, till 31st of March 2023, the Indian income tax rate was 10%, like I mentioned, and therefore the treaty rate also, most treaties have a rate of 10%. So there was hardly any difference between the Indian income tax law and the tax treaty law, and therefore that question never arisen in terms of whether foreign company needs to choose. By and large, they were happy to be governed by the domestic law, so that they don't have to produce extra documentation, and be happy with a 10% or a 10.91 if you add the surcharge and cess, 10.91% rate under the Indian domestic law. Next slide, please. So like I mentioned, most of the tax treaties we have mentioned, like UK and US, have 15% rate for royalties and fees for technical services. Both UK and US have a very narrow definition of fees for technical services, and therefore there's a possibility that certain services, especially services that do not make available any know-how or skills to the recipient of the service in India, can actually get away with a 0% withholding tax rate. But otherwise, most European nations, countries, Asia Pacific countries like Japan, Singapore, Australia, all of them kind of have a 10% withholding on royalty and fees for technical services. We can move to the next slide. So this is the crux in terms of the tax rate under the income tax law being 20%, being higher than the tax treaty rates of 10%. The tax treaty becomes more important. Next slide. But claiming a tax treaty is not extremely easy. There are aspects that one needs to consider for kind of claiming a tax treaty benefit. Especially in the last few years, the claiming treaty benefits have become more tougher, and have kind of one has to go through a kind of series of questions before one can really say that treaty benefit is available. The most important is the change by the BAP section plan on multilateral instruments, and uh, whether the whether the foreign company that is claiming the tax benefit is actually eligible or not, right? Whether it is satisfying the principal purpose test of the multilateral instrument. So because of a lot of companies taking undue advantages of the tax treaties, and taking benefits of tax treaties which they were not residents of, this concept was introduced by BAP section plan, and accordingly through multilateral instrument, they have kind of now put this into effect, where you need to comply with the principal purpose test of the tax treaty to take a benefit. Now, not all Indian tax treaties would have this, where multilateral instrument would be applicable, but a large number of Indian tax treaties would now have a principal purpose test based on MLI, and one has to kind of really take care of it. The other part one has to really comply is the actually providing documentation on tax residency and beneficial ownership, in terms of whether they are actually tax resident of that country, and and the documentation to prove the same thing. There are other aspects one needs to evaluate, is that would the Indian general anti-audit regulations be overriding the treaty benefits? Can they override, and can the treaty benefits be denied if the tax authorities in India believe that the treaty was wrongly invoked to take advantage of the treaty and take benefits under the tax treaty? Can they really deny that based on general anti-audit regulations? And also, does the treaty contain a most favored nation clause, where withholding tax rates can further be reduced even if the tax treaty does not have the reduced rate, based on the based on the treaty signed by India with other countries, uh, where the lower rate would be available? Can the lower rate be imported into my treaty based on the most favored nation clause? So these are the aspects one needs to consider for a tax treaty benefit before we kind of really apply a tax treaty. We can move to the next slide. So to avail the tax treaty benefit, three critical documentations are required. One is a tax residency certificate. Other is a form 10F, which is more of an Indian requirement. And third is a declaration from the foreign company saying that they do not have a permanent establishment, in order to kind of not attract a higher withholding tax. Now, a tax residency certificate is the most important document that is to be furnished by the foreign company to substantiate that it is actually a tax resident of its own country. Say if we take a example of a US company doing business in India, we would need a TRC from the US IRS to substantiate that the company is a tax resident of USA. Now, generally we have seen that the tax residency certificate formats are quite unique for various countries, and it does not have too many details. Therefore, the Indian government prescribed that ideally a TRC should contain a list of details, such as what is the name of the company, what is the status of the company, the tax identification number in the home country, the address of the company, and the time period that the certificate covers, right? So most TRCs we kind of get from foreign tax authorities do not have these details, and therefore a form 10F was introduced by the Indian tax authorities, saying that if the TRC does not contain these details, because these are issued by the respective tax authorities, and we cannot really kind of force them to include all of the details. So if they do not have all these details, then basically a form 10F, which basically would fill up the details which are not part of TRC, would be required. And lastly, and we'll cover both of this TRC and 10F in detail in the subsequent slides. Lastly, a no PE declaration is required, basically to confirm that non-resident does not have a permanent establishment. If there is a permanent establishment, then the taxability changes, where there could be a possibility of a very high withholding tax rate of 40% being applied, because the foreign it's kind of presumed that the foreign company is doing business by having a presence in India, and therefore higher tax rate should apply. We can move to the next slide. So this is the fact that I was mentioning, that most of the tax residency certificate being issued by foreign tax authorities do not have the requisite details that the Indian government wants. Like for example, if you look at the US TRC, there is no address available. If you look at the UK TRC, they do not mention the period of the validity of the document. If you look at the Singapore TRC, they do not provide the status, whether what kind of legal entity it is, whether it's a partnership, a corporation, that is not being provided. And Germany has a very different kind of TRC where it's specific to the recipient and the nature of income, etc. So it's not a very generic document that is available. So because all of these details are not available in TRC, the government requires Form 10F. Next slide. So this is where the Form 10F comes into picture. It is required to claim a tax treaty benefit. So again, going back to the principal thing, if you are not going to claim any tax treaty benefit, you don't need the TRC, you don't need the Form 10F also. But if you are looking at a tax treaty benefit and the TRC does not contain the requisite details, again I have mentioned that on the slide, which is status, nationality, tax identification number, tax period, and the address. If the details are not available on the TRC, then you require a Form 10F. Now, in our practical experience, countries such as Netherlands, Mauritius, Sri Lanka, Egypt, these are some of the countries that have all of these details, and therefore in these cases you do not require a 10F. Now, these are kind of the formats of TRC issued by foreign tax authorities. They are dynamic, so they may change over a period of time. Like for example, recently we started getting TRCs from Japan, Japanese tax authorities, which has started including all of these details. So this list that I mentioned is not sacrosanct. Countries can get added, some of the countries can get dropped if there is a change in the format of TRC. But essentially, if the details mentioned as per the Indian rules are not available, that is where you require a Form 10F. Next slide, please. And the no P declaration, like I mentioned, is mainly to ensure that the foreign company does not have a presence in India. Kind of, it is more like a saying that we are doing services, but we are not present in India. We are kind of rendering this offshore, and therefore the higher withholding tax should not apply. So this is more from the comfort that if there is a permanent establishment, the entire taxation scheme changes, and therefore the vendors in India, or the customers in India would kind of ask for this declaration. We can go to the next slide. So this was the rule that was in existence for quite a few number of years until July of last year, where the electronic filing of Form 10F came. And next slide, we can understand the process. We can go to the next. Okay, yeah. So basically, in July 2022, the Indian government came out with a circular that said that the Form 10F that people used to give as a signed, scanned copy over emails would now mandatorily have to be furnished electronically, which meant that they have to get registered with the income tax portal and generate a Form 10F from the income tax portal of the Indian government. Now, in order to register yourself, or in order to kind of enter the income tax portal itself, you require a permanent account number. Now, a lot of foreign companies did not have this permanent account number. They believed that they were not in a kind of legal mandate to have it, and therefore there was an issue created over here. Now, in order to ensure that kind of if they want to electronically file 10F or generate Form 10F, then they would have to kind of obtain permanent account number, and along with permanent account number, there are a host of other compliances kind of that would get triggered. We can go to the next slide. Now, considering these practical challenges which were faced by foreign companies, the government of India in December of 2022 said that the electronic filing of 10F is suspended temporarily for companies that do not have a permanent account number, or the companies that were not required to obtain a permanent account number. And up to 31st of March 2023, you do not need this. Again, on 28th of March, they further extended this suspension till 30th of September 2023. So now, if companies do not have a foreign companies do not have a permanent account number, they actually can continue with the physical 10F over the sign, scan, copy over emails, etc. till 30th September 2023. From 1st October, again we'll be back to square one, where we'll kind of look at the income tax portal to generate electronic form 10F. Now we don't know at that point in time whether the government would have done away with the permanent account number requirement to register in the portal, or what kind of form or what kind of process would be there. Possibly we'll come to know only kind of closer to the October deadline that the government has kind of set up. But if there are no changes, if things stand as it is, then after 1st of October 2023, a foreign company that wants to claim tax treaty benefit would have to kind of register with the Indian income tax portal for generating form 10F, and for registering with the Indian income tax portal they would have to obtain a kind of a permanent account number. Next slide. So this is the process that we kind of broadly define, that obtain a permanent account number and register with the e-filing portal of the Indian Income Tax Department. We need to, the person who is going to sign the form 10F, his digital signature also needs to be authorized. He has to be registered with the portal. Fill up the details in form 10F. Form 10F by itself is a very simplistic form. It has only basic details which even a non-accountant can fill in, which is basically the name, the status, the legal status, the period, the addresses. So it's very basic details. It's not complicated, but yes, the process is a little bit tedious. And once you fill up, you have to verify it using your digital signature and then generate it and then provide it to the vendor here, the customer here in India. Next slide. So this was kind of the process that I want to broadly explain in terms of the change in the withholding tax rate and the impact it has on that. So if I can kind of summarize the position till now, till 31st of March 2023, there was no changes in terms of the withholding tax rate as per income tax portal, as well as per the income tax law, as well as per the tax treaty. And therefore most people were kind of indifferent whether to take a tax treaty benefit or not. After 1st of April 2023, given that Indian income tax rate is higher, kind of it's double the tax treaty rate of 20%, there will be a kind of chance for foreign companies to claim tax treaty benefit. But for claiming tax treaty benefit, they need to have a TRC and an electronic 10F after 1st of October 2023. So it's a big change in that sense in terms of the process to claim a tax treaty benefit and looking at the tax implication in India. With this, I'll now hand over to Nishit to take it up in terms of what are the other few case studies, what are the other updates, and how this entire thing would work going forward. So over to you, Nishit.
Thank you, Maulik. So like Maulik pointed out that coupled with the change on the tax rate on various services like FTS royalty, there were other significant changes in last couple of years, which if we read with the change in the tax rate which has happened in April 2023, would create a significant impact for foreign companies doing business in India or with India. One of the important amendment to the Indian domestic tax law came in 2021, that is known as significant economic presence regulation under the Indian domestic laws. So this significant economic presence came about because of the BEPS project and the BEPS Action Plan 1, wherein the discussion was on taxation of digital economy, and where everybody felt that there is no consensus on taxing digital businesses, and current PE regulations which are there under the treaty and the local laws are not so important or relevant to tax the digital businesses, and hence significant economic presence regulations were introduced under the domestic tax law as a suggestion given under the BEPS Action Plan 1. And basis that, significant economic presence has been introduced, which is a provision which talks about taxation of any transaction which is in respect of goods, services or property by a non-resident in India. While the intent of the provision was to always tax digital transaction, but while drafting the law, they have not use the word digital transactions, and hence because of this provision, the entire transactions of sale of goods or any services or property by a non-resident with an Indian company or an Indian customer would get covered under these provisions. In addition to this, they have also covered any transaction whereby there is a systematic and continuous soliciting of business activities or engaging in interaction with users through digital means. Obviously, there are very small threshold provided for both of this. So a threshold of around $250,000 roughly is provided for any transaction. So say I'm selling goods to an Indian company as a US company, and if the value of the sale of goods transaction during the year exceed $250,000, then I would create a significant economic presence in India, and whatever income is attributable to that significant economic presence in India would be liable to tax in India. So here again, since it's a domestic tax law change, it becomes very important for companies to avail benefit of tax treaty. And again, to avail benefit of tax treaty, like Maulik mentioned, there are documentations which needs to be submitted to the Indian customers, like your no permanent establishment document, your Form 10F, and the Form 10F will become online after 1st of October. So again, in that case, you will have to obtain a permanent account number, that is an Indian tax registration number, to even submit your declarations with the Indian customer. So essentially, the move by the Indian tax authorities looks like kind of bringing more and more non-residents under the compliance net by directly or indirectly forcing them to have an Indian tax registration number and then going for compliances. Second important change which is going to happen from 1st of July is on couple of withholding tax rates, which India had a very, very liberal regime. So today, if you enter into any loan agreement between a parent and a subsidiary or a group company, where the loan is given by the foreign company to an Indian company in foreign currency, then a beneficial withholding tax rate of 5% was available to that foreign company if the loan agreement was entered on or before 30th of June. On or before 30th of June 2023. Now that provision is amended by way of budget 2023. So any loans availed by an Indian company after 30th of June 2023, that 5% tax rate which was provided under the local laws would not be available, and the tax rate will go up to 21.84%. So again, companies would have to look at the tax treaties, and the rate of interest, withholding tax rate on interest would have to be evaluated. If it is beneficial, most treaties have rates varying from 10% to 15%. So people will have to now go to tax treaty, take benefits of tax treaty, and again, for that, the documentation which we discussed, 10F, online 10F, after October, all of that would be required. Similarly, there was a beneficial tax rate of 5% on any debentures or bonds, interest received on any debentures or bonds by foreign portfolio investors or QFIs in India. That rate also of 5% has been withdrawn from 30th of June. So any interest which FPIs or QFIs received after 30th of June 2023, again, the tax rate under the local laws will become 20%. So they will also have to go back to the tax treaty and submit all the required documentation to avail that beneficial tax rate. Next slide, please. In addition to the significant economic presence, BEPS Action Plan 1 had suggested several interim measures which the governments can take till the time there is a global solution on digital businesses taxation, which has now come in form of Pillar 1, Pillar 2, which still is under discussion and not implemented. So in the interim, 2 measures or 3 measures were suggested. One was significant economic presence, one was digital service tax, and third was equalization levy. India applied 2 out of those 3 suggestions. One was on the significant economic presence, which we discussed, and second was equalization levy. Equalization levy is slightly more dangerous than significant economic presence because this is introduced as a levy. So it is neither a direct tax nor a indirect tax in India. Originally, this was introduced in 2016, which was at 6% withholding on any payment made by an Indian resident in respect of online advertising or any other related services. A 6% withholding was to be done by an Indian company. Here, the withholding obligation was on the Indian party, and we saw that a lot of large corporates pushed this liability on the Indian company by having tax protected contracts. And the provisions were kept open to include other services in future. And in 2020, a new digital taxation was brought into India known as Equalization Levy 2.0, wherein the tax rate was 2%. But the difference was that here the onus on paying the taxes was shifted on a foreign company. So now the compliance and payment on new set of services, which we will discuss in the subsequent slide, was shifted on the foreign company. So as this stands today, if the payments are related to advertising or similar kind of services, then a 6% withholding happens by an Indian company. But if it is for any other digital payments, which we will discuss in the subsequent slide, the tax rate is 2%, and that liability or the levy has to be paid by the foreign company. Next slide, please. So this digital transaction is to be paid by a e-commerce operator. E-commerce operator has been defined widely to anybody who owns a or operates or manages a digital or electronic facility for online sale of goods or online provision of services or both. And in those cases, that e-commerce operator has to pay a 2% levy. It is applicable on services, goods, online facilitator, even if you are acting as a facilitator or you are using IP, Indian data or Indian customer who is accessing your services through an Indian IP, all of that is covered. Only exception here is for non-residents who are already having a permanent establishment in India and where such services are already taxed as a permanent establishment in India. Again, there is a very small threshold of $265,000 or $250,000 in a year, below which these provisions are not applicable. Also, it would be important to note that once you come out of the royalty and the fees for technical services definition, then you have to also check whether equalization levy is applicable or not. So if you are liable to pay tax as fees for technical services or royalty, you pay tax there. If you say that it is exempt, then you have to test whether it is covered under equalization levy or not before taking a position that it is not taxable at all in India. Next slide, please. Next slide. So with all these changes, what happens, like I mentioned earlier, was that a compliance burden has been casted on the non-resident taxpayers due to the way the provisions or the law is worded in India. Currently, in respect of tax return filing in India, the law is very widely worded to say that every company is required to file a tax return in India, and a company is defined to include a foreign company. So if I read it very literally, it means that every company in the world is required to file a tax return in India. Now, if we look at it at a more logical level, then the reasonable interpretation would be every company earning income or taxable income in India under the local laws of India would be liable to file a tax return in India. So any company which is having transactions with India would have to actually evaluate whether you are required to file a tax return in India or not. So earlier what was happening, that there was an exemption from tax return filing provided under the Indian local laws, wherein if your withholding tax in India was happening as per the local laws, then there was an exemption given from filing a tax return in India. Now what they have done is that the local withholding tax rate has been increased from 10.92%, like Malik discussed, to 21.84%. Now this change would force many companies to avail tax treaty benefits because the tax rate under the tax treaty are either 10% or 15%. The moment you go under the tax treaty for the beneficial rate, then technically you will be obliged to file a tax return in India, because your income is liable to tax under the local laws and you are claiming a special tax rate or a provision under the tax treaty, and for that the exemption is not applicable. Similarly, if your transactions are with related parties, then you will also be obliged to carry out compliances from a transfer pricing perspective, like filing of a local form, maintain local file, and depending on your turnover in India, there could be possibility of a requirement to file a master file notification. Also, one transaction which traditionally nobody paid attention to was sale of goods to an Indian company. That also will now become a bone of contention in India to see whether you are required to file a tax return in India or not, because any non-resident doing sale of goods in India now will have to go under the tax treaty to avail or to say that I don't have a permanent establishment in India and hence the income is not taxable. With significant economic presence provisions coming under the law, it may be difficult to argue that the sale of goods are not taxable under the Indian tax law itself. So all foreign companies with whatever transactions they are having with India will have to now relook at their compliance obligations in India in light of these changes. Next slide, please. Now we move to some case studies just to get a flavor as to what kind of typical transactions we have seen and what potentially could be implications on those transactions prior to the law change. So one of the very important transaction which most of the companies and what most of the Indian companies we have seen doing with foreign companies is on purchase of software. So we have seen a lot of software purchases, license purchases are happening by Indian companies from foreign vendors. So software taxation has been traditionally a highly litigated matter in Indian courts. The controversy arises from the fact as to whether the sale of off-the-shelf software or string-wrap software is in the nature of royalty or not. Tax authorities in India have been arguing that whenever a license is granted to the user in India, or there is a transfer of a shrink-wrap software to an Indian user, invariably some amount of copyrights are transferred to that Indian user, and hence this is nothing but transfer of copyrights in a product, and hence it is covered under the definition of royalty under the local laws of India as well as under the tax treaties, and accordingly it should be liable to tax as royalty. In India prior to 2021, there were rulings on both sides. There were few courts wherein it was held in favor of taxpayers, stating that this should not be liable to tax under the Indian local laws as well as under Indian tax treaties with various countries. Similarly, there were few decisions where it was held that no, this is liable to tax in India and hence taxes should be withheld. Finally, in August 2021, the Supreme Court of India, the Apex Court of India, ruled on the matter in the case of engineering analysis, and it held that in case of sale of a shrink-wrap software or a standard software, there are no copyrights which are transferred by the seller to the user, because this is generally a non-exclusive, non-transferable license enabling only use of a copyrighted article, and there is no transfer of copyrights in that particular article, and basis that it was held that this is not liable to tax under the respective tax treaties. Under the local laws, given the amount of controversies, there was an amendment made to the local laws by the Indian tax authorities. So now any transaction on software is always liable to tax under the local laws because the definition has been expanded. However, there is possibility to take a position depending on the facts of each case to say that software transaction is not liable to tax in India, relying on the Supreme Court decision. Only thing is, the moment you go under the tax treaty, all the documentation, tax return filing obligation, all of that would come into picture. Next slide, please. Also, this decision there is a review petition has been filed by the tax authorities. Tax authorities in a way have requested the apex court to reconsider their decision, and that hearing is pending. But as on today, the Supreme Court decision is available and the position is in favor. So like I was saying, if we look at a transaction type where a US company transfer a standard license for a product like say a Microsoft Excel or a Zoom license or something of that sort to an Indian company, which is standard product available to everyone, then potentially a position can be taken that it is not liable to tax in India since there is no transfer of copyrights under the tax treaty, not taxable. However, if this transaction was happening prior to April 1, 2023, a 10.92% withholding potentially could have been done by an Indian company under the local laws. Or if a tax residency certificate and a no PE declaration along with a manual form 10F, that is a physical form 10F, was provided, potentially the transaction could have suffered a nil withholding tax. However, post April 1, 2023, if you are not providing any of the documents like a tax residency certificate or a form 10F, the tax rate would go up to 21.84%. And post 1st October, you will need a electronically filed form 10F in addition to the other documents which we discussed. So this is going to change a lot of things from 1st October. And in order to even obtain an electronic form 10F, you would need a permanent account number in India. And the process of obtaining that permanent account number itself may take around 1.5 months. So if you start doing, if you want to actually submit an electronic form 10F to claim a nil withholding tax rate in this kind of a transaction, you may have to start applying for a permanent account number now, so that you are prepared with the Indian tax registration number and are able to file a electronic form 10F by 1st of October 2023. Next slide, please. Now, if we look at another scenario, say a US company is rendering certain technical services, say IT support services to its Indian customer. In that case, again, India-US tax treaty has a favorable clause which provides that the services rendered by a US company to an Indian company would be liable to tax in India only if there is a transfer of knowledge by the US company to the Indian customer. And only in those cases that services would be liable to tax in India. So if this transaction were to happen before 1st of April 2023, under the local laws, it would have suffered a tax of 10.92. However, under the tax treaty, potentially there was a position available to say that this transaction is not taxable in India since there is no transfer of knowledge. If there was actually a transfer of knowledge, then under the tax treaty, the rate was 15%. So by and large, the US company would have opted to go under the local laws and pay a tax of 10.92%. The moment the tax was paid under the local laws of 10.92%, there was an exemption from filing a tax return in India. So only transaction would have been receipt of service income from Indian customer after deduction of 10.92, and then no other compliance required by the US company. They only had to submit a no permanent account declaration or a permanent account number or a relevant declaration that they do not have a PAN, and they submit any other proof. But now, post 1st of April 2023, they cannot take that position because the tax rate goes up to 21.84%. If they don't want to file a tax return in India, they will have to suffer 21.84% tax. Potentially, if they pay 21.84% tax in India, it is possible that in US, the tax authorities may not allow credit of the excess taxes paid in India. The tax authorities in US may say that as per the tax treaty, the tax rate is 15%. So you will get a tax credit only up to 15%. The balance tax paid by you in India is a voluntary tax paid by you, and I will not allow the benefit. Similarly, a 10% rate is there in other treaties like Singapore, Germany, etc. So in those countries, the hit would be even higher because 10 versus 21.84. So now it will become important for them to give a TRC, no PE declaration and Form 10F. And post 1st of October, again, electronic Form 10F would be required to be given. Next slide, please. Now, this we discussed mainly if you are selling goods into India. Prior to 2022, a position was that since this transaction is executed outside of India, the payment is made outside of India, the sale is concluded outside of India, assuming your Incoterms are FOB, freight on board. So a position was taken that this is not taxable under the local laws of India, stating that the transaction or the ownership of the goods have passed outside of India. But with significant economic presence regulations coming in, now any transaction beyond the limit of $250,000 would be deemed to having constituted or significant economic presence in India, and hence to say that this transaction is not taxable in India would become very difficult, and potentially withholding tax in such kind of cases is 43.68% on a net basis. So in order to even determine, when I say net basis, it would mean income minus expenditure. Even for a withholding person who is the deductor, even to understand what is your expenses, he would essentially ask you to get a order from the tax authorities. So nobody would want to get into this situation. So now again, for this kind of transaction also, you will have to take a shelter under the tax treaty. And in those cases, again, the documentation which we discussed earlier would be applicable. Next slide, please. So last case study, again, an example of a UK company providing services, IT support services to an Indian customer, which happens to be its subsidiary or a group company. Most of the services are provided offshore, sitting in UK. However, in few cases, the employees are traveling to India to provide services. But in addition to that, since the UK company is the parent company of the Indian company, they also travel, employees of UK company also travel to India for various other reasons like governance meeting, for shareholder functions. So here, to evaluate the taxability of the payments for IT support service, again, under the local laws, this would be taxable at 21.84%. Again, UK, similar to India-US tax treaty, has a provision wherein it provides that such kind of services would be taxable in India only if there is a transfer of knowledge. So if you are able to satisfy that test known as make available test, then you can opt for a nil tax rate. Otherwise, the tax could be 15% under the treaty, subject to submission of all the documents, or 21.84% under the local laws, which is provided. However, whenever you are going for a nil tax rate, in this kind of situation, it would be very relevant to examine the service PE clause, which is there under India, UK, India, US kind of treaties, which trigger if the services are rendered by coming to India, and there are threshold provided of generally 30, 60, 90 days in various treaties as to when a service PE would trigger. So it would become very critical to evaluate a service PE exposure also. Also, it would become very, very critical to examine or keep records of why the employees are traveling to India, whether it is to provide these IT support services or the travel is for other shareholder functions, which they render as a parent company of the Indian customers. So next slide, please. So just to summarize on way forward, how a foreign company should go about in terms of evaluating the recent changes in India. Next slide, please. There are 3 to 5 items which all companies would have to evaluate. First would be to kind of see, with the change in the tax rate, what is the increase in tax cost because of these changes, and then evaluate whether it is worthwhile to go and claim the tax treaty benefits. And if you decide to go for tax treaty benefits, start preparing for the documentation which your customers in India would start asking from, or they would have already started asking you to provide electronic form 10F or various kinds of declarations. So like I mentioned that even if you need to provide an electronic form 10F on 1st of October 2023 onwards, you will have to start action now, because obtaining a permanent account number itself would require certain apostille documents from foreign country, which itself will take time. Then the processing would take time, and we've seen that this process of opening in an Indian tax registration number may take around a month's time. So the preparedness would become very, very relevant. It is possible that in various cases earlier, even though there were certain treaty benefits like position of not the revenue being not taxable because of the make available clause or because of the Supreme Court decision, but since the tax rate was only 10.92% and you were able to claim a tax credit in US or in UK, you were not kind of too worried about the 10% tax paid in India. But now if that tax cost is going to go to 15% or 21%, you need to actually evaluate the tax position adopted in India are correct, or whether you want to evaluate again in light of the recent changes, the judicial precedents in India, and see whether you want to take a different position. And lastly, obtain the permanent account number, be geared up for the compliances which you need to do in India, and obviously prepare for the same with whatever transactions you have in India. So with this, we kind of end our presentation, and happy to kind of take questions which may be there from the audience.
Thank you very much. And as Nishit said, we're going to move on to our Q&A session now, but I would just like to first and foremost say thank you very much to Maulik and to Nishit for your fascinating insights today. We really appreciate your time and your efforts putting this presentation together. So we will move on to the Q&A session now, and I please do ask if you have a question to send it in to our panel now. Cindy asks, must a foreign entity have a PAN in order to claim tax treaty benefits?
Cindy, indirectly, yes, from 1st of October 2023 at least, because you require an electronic form 10F after 1st of October. And for getting an electronic form 10F, you will require a permanent account number. So it's though not directly mandated by law, indirectly because of the process set in by the government, you will require a permanent account number for claiming the tax treaty benefit.
Brilliant. Thank you very much for that. Anna Rude asks, how does the increased withholding tax rate compare to the withholding tax rates in other countries for foreign companies?
Anirudh, I think a lot of foreign companies, foreign countries, especially in US and Europe, have do not have a withholding tax rate for large number of payments or different nature of payments, etc. And even if the withholding tax rates are there, they are 10% or something like that. I know US in particular has a 30% withholding, but that only if you do not comply with certain conditions and if the services are rendered in United States and not from abroad. So to that extent, the Indian withholding tax rate regime is one of the most comprehensive and kind of more comprehensive regime as compared to some of the other Western countries at least. A lot of Asia Pacific countries have started putting down withholding tax regime on the same line as India, especially Malaysia, Japan. Those countries also have a rate which will be in the range of 10% to 20% and a regime which is similar to India.
Excellent. Thank you very much for that, Maulik. Nihar asks, how does the change in withholding tax rate under the India income tax affect the requirement of filing returns in India?
So like I pointed out earlier, that the provisions for filing of tax returns in India is very wide. It says that any company is required to file a tax return in India. So logically, any company earning income from India is required to file a tax return in India. There was a specific exemption provided from withholding if the taxes were deducted under the local laws, and hence many companies were going under the local laws for withholding and claiming exemption on filing of tax return. But now that the rate is increased to 21%, indirectly many companies would be forced to go under the tax treaty. And the moment you go under the tax treaty, the return filing requirements would trigger.
Excellent, thank you very much. We've had a question in from Mary. It's quite a detailed question, so I'll do my best to ask it to you. But of course, Mary, if you need any further information, and this goes to everybody, please do reach out to Maulik and Nishit afterwards. But Mary asks, how does this impact foreign colleges training students and teaching online? So a student in India, teach a core course available in Canada. Also a transfer of knowledge, so making education material available to residents of India, but material created and made available from Canada.
So typically in respect of education institution, specifically Canada treaty we'll have to revisit, but many treaties like US, UK provide for certain exemption for education institution. Also, certain treaties provide exemption if the services are B2C. So this will have to be evaluated treaty by treaty. Again, what is to be considered as make available? There is obviously various parameters which needs to be looked at as to how the agreements with the students are drafted in terms of what kind of services are provided in order to comment on whether there is a transfer of knowledge or not. There is again a lot of jurisprudence in India on this subject, so it would be fair to evaluate the document before commenting on that. But at a very high level, if something goes in the modes of teaching, training, where that person is able to kind of imbibe that thing for future use, even though he may or may not use it, then potentially it could fall under the make available clause. But like I mentioned, good to see the document before conclusively commenting on that.
Brilliant, thank you very much for that, Nishit. I'm just looking at the time, and we've had a great question in from Edward, but Edward, what I will do is send that on to the panel after this webinar, and they'll be in touch. But I did want to ask to both of you your key takeaways that you would like our audience to leave today's session with. Maulik, if I could perhaps start with you to answer that. Sorry to put you on the spot.
No. So then essentially, if there are foreign companies, people who are doing businesses with India, they need to relook at the business structure that they have, whether their contracts are tax protected or not, whether they are facing any tax implications from the Indian customers, and what kind of documentation the Indian customers are demanding from them. And it's kind of important to keep the management aware that there is a higher withholding tax implication, and therefore get prepared for kind of getting an Indian permanent account number in Indian compliances.
Brilliant, thank you very much. And Nishit, if you have any closing comments for us as well.
Yeah, so just to add to what Maulik said, that say for example you kind of decided on a position that this transaction which you're doing with India is not taxable, then please make sure that you also look at the other provisions on equalization levy to ensure that by moving out of taxation from royalty or fees for technical services, you are not falling under equalization levy, because there the direct compliance requirement is on the foreign company. So it is important that you look at your entire transaction from all the aspects. One is on the withholding tax side, and second also from an equalization levy perspective.
Excellent, thank you very much for that. So once again, thank you to our panel, to Nishit and Maulik, to everybody at Nexdigm for putting this webinar together. It's been a really fascinating session, and we really appreciate that. And thank you to our audience as well for being with us today. We really appreciate you being with us. We hope that we can see you again soon. But for now, I will say goodbye.
Thank you. Bye.
Thank you.